Will the alarming news of Omicron derail the Fed's plan to taper and hike rates? Hi, I'm Jim Griffin of Derivative Logic, here to get you straight to smart. Omicron has sparked fresh worries among investors about travel restrictions and the possibility of fresh lockdowns and other non-pharmaceutical measures aimed at quelling a new virus outbreak. Last Friday saw the yield on safe haven treasuries fall a whopping 18 basis points from Wednesday's close. Stocks tied to the economy's reopening, such as those in the travel and leisure sector, took a beating. While covered elsewhere extensively, the South African strain seems to have a high number of mutations that experts believe may make it more transmissible and allow it to dodge some immune responses induced by past infection or an immunization. The news spurred bond traders around the world into action, who pushed out the expected date of the first post-pandemic rate hike from June of next year out to September. The yield on the 5-year Treasury note, which has long been a gauge of future Fed rate moves, declined 18 basis points, while the 10-year Treasury yield slipped below 1.5%. The sharp drop in rates demonstrates how polarized opinions on the future path of interest rates had grown, leaving the bond market vulnerable to a pandemic plot twist. And boy, did it get one. Our take? That was definitely a quick and brutal move in yields, and one that has reset Fed tapering and rate hike expectations. While the mutation's impact on markets is tough to predict, one thing is clear. Markets can no longer view the pandemic as if it were in the rearview mirror. In the meantime, moves in yields like we saw last Friday will wreak havoc on the cost of rate caps and swaptions, driving them higher as fixed income traders and the banks they work for struggle to figure out how to position themselves in the shifting sands that is now a new and improved COVID-19, and not in a good way. The bottom line is that while the Omicron news is indeed concerning, the major issue for the bond market right now is analyzing the path of what will likely be tighter policy from the Fed next year amid a continuing trend of higher rates and a flatter yield curve. In the meantime, though, get ready for more interest rate volatility as markets figure out if the Omicron threat is real. Greater rate volatility solidifies the need for a seasoned advisor to help you navigate your way through the uncertainty that lies ahead. Do you have one? From all of us at Derivative Logic, have a great week.